There's a new financial game being played today in the marketplace. And before I get into the details of it, let me just say that I am not anti DSO, necessarily anti private equity. I'm not anti anything that is a good deal, a good transaction, a win win for both parties. Bottom line, that's what capitalism is. And whether it's private equity, DSOs, private sales, whatever it may be, if it works for the benefit of two sides, the two parties, buyers, sellers, to the goals that each party respectively wants, then it's a good deal. The problem is that many times the what's promised on the front end doesn't happen on the back end, just to say it bluntly. And that has to do with pro formas. Look, we deal with pro formas all the time when we're looking at potential real estate investments, particularly those on the equity side, where we're taking a stake in the ownership of a particular asset, a property, a fund, a syndication. And the promise generally is if the operator, whether that's you with your own property or that's the syndicator or the fund manager, does a good job with the assets, that they're going to drive value in the assets and drive the value up to a point where the asset can, equity, the profit, the capital gain can be harvested for a nice return, a capital gain return, along with possibly some distributions along the way, right? That's the play. And when the markets are going up and we've had cheap capital for many, many years, up until the last 2 years, this trend generally has worked very, very well. Because when you can roll debt over and over and over again at next to zero interest rates, it's not costly to do that. It's not high risk to do that. Things change when the markets change, and we've seen great disruption in the marketplace in the last 2 years when we had inflation coming back at historic highs, 9% back in September 2022. The Fed comes to the rescue, so to speak, and says, well, we're going to tamp down this inflation. It's just transitory. Trust us. We'll raise interest rates up. And so they did. And yes, inflation has come down, but the problem is we still have high interest rates and we still have an economy that is, I would say, suspect. Let me just put it that way. I think it's very suspect. All right, back to the premise of what's happening. So we've talked a lot about DSO and private equity sales and transitions and how much one has to be aware of, in my opinion, how much capital investment that the seller, might be you with your practice, is leaving in the parent company, the holding company. That's always the play. The play is the DSO, backed by private equity, will come in and make an offer, a total offer on the practice sale. And those offers in the last 5-6 years have traditionally been on a nominal basis. What I mean by nominal, the actual stated sale price has been a higher multiple, a higher number than, generally speaking, the private market would pay, a private practice sale to another practitioner. Private practitioners have to come in with cash, hard money, and bank financing, and banks look at evaluation a certain way. Well, private equity plays a different game, and they've played this for decades. For decades, this has been going on in all industries. We've just seen it in the last 6, 7, 8 years, pretty heavy into dentistry, veterinary medicine, many other industries. And so the play is, we'll give you what looks like a nominally high valuation for your asset, your practice in this case, but we're not going to give it all to you up front. We're going to give you a certain percentage up front, and then the rest of it we're going to keep over here in a side bucket, which is our company, our fund. And because we're really good at managing money and aggregating practices, you're going to likely get a 4 or 5 times more multiple on that retained equity that they're retaining over here on the side. And that's worked out in some cases, but not all. And we're already seeing the headwinds in many of these roll-ups that are taking place, where I think we're going to see more and more of the recap promises being extended out or may not happen. I'm just saying that's the case because, again, where the economy is. So now what's happening is a lot of this money that's been buying practices and doing these roll-ups are realizing that they've been overpaying for practices, and particularly with the higher interest rates that we have today, those practice valuations don't make sense. Even private equity, who thinks they can do no harm or do no wrong, they're realizing that this does not have a run rate to it. But they're coming to that realization. So now many of them, or some of them I should say, are moving to actually buying the real estate owned by the practice operator owner. Could be you. And that, again, that can apply to dentistry, to medicine, healthcare clinics, veterinary medicine. In the past, usually those who buy the actual operating business, the practice itself, don't want the real estate because the real estate takes what? A lot more capital. You've got to go finance that, and you've got to put hard money down. And when you have to put hard money down and your operations are really not in owning real estate, that doesn't make sense. It makes sense many times for the DSOs to buy the practice, and then they will lease the practice facility back from you, the dentist, and they'll create terms to make that work. So it's usually an either or. They'll either buy the practice, or in this case, they're starting to shift to the real estate. Well, why the real estate? Well, the real estate, by and large, is easier to fundamentally value, right, than a practice. It's fundamentally easier to value. That doesn't mean there's not fluctuations in real estate prices. There always are. But that being said, it's easier to put a valuation on them. Similar to what they've done with practices, they're now coming in and offering practice owners without buying the practice. You own your practice, you like your practice, hey, but how would you like to capture some equity out of that building? And let's say you've got a building that has got a lot of equity. You've paid it down over the years. You don't hold any substantial debt, or maybe no debt at all. And let's say you've got a building that's worth, in the marketplace today, a commercial building, your practice building, and let's just say the commercial brokers would put a value on it today of maybe $700,000. Just put a number on it. So private equity will come in and say, hey, we'll pay you $1 million for that practice building. And you're thinking, wow, $1 million. And now you can have that equity, and you can go make money on your equity, and you can untrap that equity. I mean, that's always the game, right? Untrap that dead equity. Well, it's not dead equity if you're using it, or somebody's using it. In this case, you're using it. It's not dead equity. So you have to kind of compare and contrast. And of course, if you give up and sell your building, in this case, get the $1 million, then you're going to have to pay rent to the new owner, right? So part of the caveat is, well, how much is the rent going to be? And you're thinking, well, they'll just charge me kind of normal market rent. No, they're going to charge a higher rent. Trust me. They know what they're doing with the numbers. So they can play games just like they do with the practices. And this maybe gives a more clear insight into what they do with the practice. They'll tell you they'll give you $1 million for a $700,000 building. And then they're going to tell you, and here are the lease terms. We want you to sign a 10-year lease. That's not uncommon. And there's going to be escalators, normal escalators tied to some index, similar to CPI, but there's other indexes they'll tie it to. So there's going to be increases along the way to keep up with inflation. And in a particular deal that I was helping someone look at, because they had this actual opportunity come up, and I'm actually giving you the numbers of their deal. It was a real estate practice building that was valued real time in the market for $700,000, and the private equity said, we'll give you $1 million. And he thought, well, that's great. Well, here's how the terms work, though. We're not going to give you the full $1 million. We're going to give you half of that. We'll give you $500,000 in actual cash, and we're going to take the retain amount, the $500,000, and we're going to put it in our fund. Got it? See how it works? Put it in our fund. We've got this real estate fund, and we're aggregating all these medical, dental, veterinary practice, optometric, whatever it could be, and we got this fund, and we're going to manage all this real estate together, and we're going to build up again the NOI, the cash flow, which is that's what drives the real estate values. It's like EBITDA in a practice drives the valuation for a practice. Well, it's NOI, net operating income. Well, we're gonna drive that. We're gonna add value, drive it, whatever, and particularly if they're charging you a higher rent amount. So here's the catch: to pay this guy $1 million. $500,000 he gets to have. $500,000 goes into the fund, so you don't get to get that. That's going to be in the fund, and you'll participate in whatever that fund does over the years with the promises of the typical. We'll give you a 4 or 5x on that $500,000 in 3 to 4 years. And you're thinking, well, why wouldn't I do that? I can't get in the marketplace. I can't get that anywhere else. Yeah, but can they really drive it with interest rates where they are today? With the fact that I think we're going to have more of a stagflation, probably a recession correction in the overall economy, notwithstanding asset prices. And you think in 3 or 4 years you're going to somehow get some big multiple? I think not. And of course, like anything, you've lost control. You've lost control of a really solid asset that, in this case, with your practice, you're using it. You've given up control. They wanted $8,000 per month on the leaseback rent. Now, I asked this person, I said, what's the market? I said, I said, have you talked to a commercial real estate broker in your market? What is a medical, in this case, dental facility? What's the normal range for a lease? And he was told it's 4,000, around 4,000. So basically, they're asking the seller of the building, who they're going to give $1 million, but only half of it up front, they want double the rent. Oh, and guess what? That $8,000 per month, that's net. It's a triple net lease, which means that that's a guaranteed amount that gets paid. It's net to the fund owner, the buyer of the building. It's net to them. Means that you, the lessee, you're now leasing back your building, have to cover all the other stuff you normally had to cover anyway. Taxes, insurance, common area maintenance, CapEx. I mean, you basically still have all the owner obligations of the building without owning the building. You carry all that stuff. And what's happened to property taxes and insurance in the last year? Just ballooned. Well, guess what? In this kind of a triple net lease arrangement, you suck that up as the lessee. The lessor, the owner of the building, it doesn't bother them. You're guaranteed to pay them $8,000 a month with escalators. So let's just do the math, and this is easy to do in my head. If they're saying the building is worth, and they're going to pay you $1 million, again, half up front, half somewhere in the future. So that, in my mind, right there is not a full $1 million sale. But get this: if I'm paying out $8,000 per month, in my head real fast, I can do the math. That's $96,000 a year. And if the valuation on the building is $1 million, quick math in my head, that's a 9.6% cap rate. That's extremely high. Who does that benefit? It benefits the owner, the buyer of the building, not you as a seller. If you're a seller, you want a low cap rate. You want to sell that building like down, like probably in a market like this. It's probably, that would be a cap rate of probably around, I'm gonna say 6.5. They boosted up to 9.6. So now you're paying a very high cap rate on a building you just sold and thought you got $1 million for. Now let's, over 10 years, 10-year lease. Let's see. Again, I can do this in my head. $96,000 a year times 10 years, plus there's gonna be escalators. Let's just keep it at the flat rate 8,000 without the escalators. That's $960,000 I will have paid, guaranteed, to the owner of the building over 10 years. In other words, they've recouped over 10 years all the money that they paid out to acquire my building. Who benefited there? Plus, whatever there is in inflation, right? They capture all that. Basically, I've paid down whatever debt that they had to use to acquire that. I paid it down for them, and now I no longer have the asset. It's gone. But I got $500,000. What can I do with that $500,000? What are you going to do with that? You've always got to consider, before you take cash out of anything, cash out of whether you refinance money out, or someone buys you out, your practice, your commercial building, any other assets you have, before you decide to grab the cash, you got to say, what am I going to do with that cash? And can I do better than my current position? That's always the key. Can I do better than my current position? In some cases, it would make sense. Some cases, if you got the right numbers, it could make sense to harvest equity out of an asset. But you've always got to consider the long game ramifications. That's what most people don't do. They can't perceive and look down the road, or they take that high pro forma. Oh, we'll give you a 4 or 5x multiple on this retained equity that you're leaving, with us, and you're going, well, for sure, because that's what they've always done. No. You probably just gave up, a lot of that equity. And as I said, you've tied her down to a high lease payment. So what did that just do for you? Well, that just cut your cash flow down for all those years. So it's a balancing act, and it's interesting that these companies, these private equity backed organizations, DSO type, are telling the potential seller of the practice building, well, we're flexible, we're negotiable. If you want a little bit more for the building, we can do that, of course. Yeah, all we'll do is just fudge the lease back up. I mean, you can play these numbers all day long and play games with it. We'll give you on a pro forma a much higher multiple to juice it up for you. It's just all a game and math. And so it was fun to help this doctor look at the options, because at first he was like thinking, man, I can get $1 million for my $700,000 building. Well, if everything's even, then yeah, that sounds like a great deal, doesn't it? But you've got to consider all these other factors before you actually plunge in and say, I'll take the deal. because usually, in most cases, the big money, the private equity money, is smarter than you are because they play the game with the numbers and you don't. And they know how to fix it in their favor. It's what they've always done. So I thought it was a great way to kind of compare and contrast something that we know a lot about, real estate, and compare and contrast that to how private equity plays the numbers in any of the industry assets that they purchase with here's how much we'll give you up front, here's how much we'll give you later, and how they play the numbers to make it always work in their favor. Just beware. It's just another lesson to keep in mind.